At the beginning of this year, ever since 2014, I kept hearing that a real estate crash was right around the corner every single year. Baseball analogies are often used in the industry to describe real estate cycles, and 6 years ago, everyone seemed to believe that we were in the seventh or eighth inning of a 9-inning ballgame. Fast forward to 2015, and I heard the same thing. And fast forward to 2016, 2017, 2018, and 2019, and we were still in that same home stretch of the real estate cycle, according to many experts on panels at investment conferences and authoring major investment research. And in 2020, the guys calling the crash in 2019 were finally right. But the problem was that most of those people were also calling it for the 5 years before 2019, and they were wrong every time. And being wrong in this case is a really bad thing because believing a crash is coming generally means waiting on the sidelines and missing investment opportunities, essentially hoarding cash for the next opportunity that always seems to be right around the corner. So if you're a real estate investor looking to grow your portfolio or just looking to get into the game with your first real estate deal, if you want to make sure you're not buying at the peak, but you also want to make sure you're not missing a wave of growth if a downturn doesn't occur when you predicted, how do you do this? And is trying to time the market in real estate even something you should be considering? That's what we'll cover in this video. Hey, this is Justin from BreakIntoCRE.com, and if you're new here, on this channel we talk about real estate investment analysis and real estate investing careers. So if you're looking to break into the industry or do your first or next commercial real estate deal, subscribe to the channel and hit the notification bell so you'll catch all new videos as soon as they're released. So if you're watching this channel and have friends in either the real estate industry or looking to make their first real estate investment, you probably have at least one friend that's convinced that he's waiting for the market to crash and he isn't going to buy anything now because deals are too overpriced in his market. For people like this, the motto is always next year, patiently waiting on the sidelines for some major event to occur that triggers opportunity. Well, in 2020, that event actually happened. And many of these people that talk about doing deals end up falling by the wayside at this point in the game because they're not really willing to walk the walk when it actually comes down to it. But even for those who do try to take a swing, to jump in to seize that opportunity that is now finally present in many major product types and markets today, the majority of these people will still end up on the losing end of things. And in my experience, there are three main reasons why this is likely going to be the case and why trying to time the market is generally a loser's game that does more harm than good for a real estate investor in most cases. And the first and one of the most important reasons is that if you're wrong about a crash and you sit out an upcycle, you're missing prime investing years in a number of different ways. So the first and most obvious part of this is that compound interest is strongest when you're young, meaning that every dollar you invest earlier on in your career is worth much more to your future self than dollars you invest in the future. So a simple example of this is investing $25,000 in your first deal at 25 years old versus investing that same $25,000 in your first deal at 30. So to run some basic math on this, if we assume a 12% annual rate of return, which is very reasonable on a real estate deal with moderate levels of leverage, the difference is massive once you start looking at long-term results between the two scenarios. So if you make your first investment at 30 years old, that initial $25,000 investment grew to just over $838,000 by the time you're 60 years old, which is definitely a respectable number. But if you made that same $25,000 investment just 5 years earlier at the age of 25, that same $25,000 investment grows to over $1.478 million by the time you hit age 60, which is a whopping 76% higher than the scenario where you waited just 5 years to invest in real estate at 30. And on top of the numbers backing this up, from a less quantitative, psychological, and life perspective, you also have the greatest ability to take chances on investment or even real estate career opportunities when you're young. One of the quickest rises I've ever seen by a real estate investment firm was a group of two guys in their late 20s that started buying properties and building their portfolio in 2016 when everyone was calling the end of the cycle. Well, it turns out that the end of the cycle was not in 2016, and since then, that group has acquired over 3,000 multifamily units, successfully sold or recapitalized many of their deals, and have built an entire team in the process. And if they had waited until the bottom fell out of the multifamily market, they would still be waiting today, and their overall life overhead and responsibilities would probably be significantly higher in their early to mid 30s at this point, and there's no guarantee that they would have been able to take the leap whenever that opportunity would have occurred. Now, aside from the time value of money reasons for not trying to time the market, there are also other quantitative reasons at play here. And one of the most straightforward reasons why waiting it out and trying to time the market doesn't generally work in an investor's favor is because in most years, commercial property prices go up. So Green Street Advisors is a very well-known real estate investment research firm that has been tracking commercial real estate property prices since 1997, creating what they call the Green Street Commercial Property Price Index, or CPPI for short. And according to CPPI data, commercial property prices have only gone down in about 2.5 of the 23 years tracked in that analysis, with those downturns only occurring during the Great Recession between the summer of 2007 and the spring of 2009, and during the most recent downturn in the economy between February and July of this year, when lockdowns and closures were at their peak here in the US. But during all other periods, the general trend of pricing has been up and to the right, and since they began tracking the index in December of 1997, commercial property prices have increased at a compound annual growth rate of 4.22% up through August of 2020. And this growth rate even includes those massive value decreases during the Great Recession, with the CPPI dropping almost 37% between 2007 and 2009. And what's really interesting to note is that these property value increases only represent unlevered data. So most commercial properties are acquired with debt, meaning that a 4.22% annual increase in property values themselves likely meant significantly higher equity increases for investors who also added leverage to their deals. So using a conservative 65% LTV ratio on a sample $100,000 property acquisition, roughly $35,000 of equity would be required to close on that deal. And assuming a 4.22% property value increase in that first year of ownership, that would bring the property up to a new value at the end of that first year of $104,220, meaning that even if the loan balance wasn't paid down at all and stayed the same at $65,000 at the end of the year, that new equity balance would represent $39,220, representing year-over-year equity growth for the investor of 12.05% rather than just that 4.22% value increase seen at the property level. So the bottom line is here, based on historical data, if you're sitting on the sidelines waiting for the right opportunity, chances are you're just saving up your money to buy more expensive real estate later on in the future. And finally, if neither of those first 2 points convinced you, the final reason why timing the market generally doesn't work is because gaining investment experience is really the only way to actually know what you're doing when opportunity like this does end up striking. So by investing consistently over time, you gain experience. And with that experience, you learn the markets you like and you don't like, the property types you like and you don't like, and if you're investing as a limited capital partner, the sponsors you like and don't like as well. And in the process of making investments, you'll also build relationships so that deals will be sent to you when that distress starts to occur, rather than having to seek them out on your own, starting from scratch when opportunity in the market comes along. So if you're an active investor, this means that brokers and lenders will be calling you, knowing you have a track record and can close on deals when new opportunities arise. And if you're a passive investor, you'll already have a network of groups that are going to be sending you opportunities, and you'll know the groups you like and trust before investing a huge chunk of capital in a new investment opportunity. Investing gradually each year, especially during up years, can also help you grow your capital much more quickly than you would have been able to otherwise, giving you even more investment capital to work with than if you just sat on the sidelines before a major correction. And this has been very true in my own portfolio, and over the past 5 years, I've benefited from several major capital events, including refinances that returned most or all of my invested capital, several major property sales that were either distributed as cash or rolled into a new, bigger investment as a 1031 exchange, and even regular cash flow distributions that have allowed me to make bigger and more frequent investments than I would have been able to otherwise if I had only kept that money in a savings account over the last half decade. So overall, for these reasons, some form of dollar cost averaging or making consistent real estate investments over time generally makes more sense for most investors than hoarding cash for a potential correction that you may be waiting years to get into. And if the big price tags of commercial properties make this feel impossible, one thing to keep in mind is that you don't always have to start with a massive capital investment. So most investors can start by accessing things like REIT shares for as little as a few $1,000s, and if you can make an investment from around $10,000 to $50,000 to get started, that can generally get you into single-family rental houses in many US markets, passive syndication opportunities, investing as a limited partner, or even bigger commercial properties where you are the general partner on the deal, assuming you are raising third-party LP equity to come in for the rest of that equity requirement. However you decide to do it, you don't want to be the person waiting on the sidelines for the right moment, only to be sitting in some sort of quiet desperation until that time finally comes. And when that time does come, you might not even be ready to capitalize on it if you haven't been doing deals in the meantime. So I hope this is helpful to get a little bit more clarity with so much volatility in the stock market right now and fear around investing in general at the forefront in the news today. And as always, if you want to go deeper into any of this and you want to learn more about how to analyze deals to find the right opportunities, regardless of the market cycle we're in, make sure to check out Break Into CRE Academy, which is going to give you instant access to 19 courses on real estate financial modeling and analysis, access to a full library of real estate financial models and Excel training files, and some additional one-on-one support, and I'll link that in the description below. Also, make sure to let me know in the comments your thoughts about timing the market from a real estate perspective. And if you like this video and want to see more content like this, make sure to hit the like button and subscribe to the channel so you don't miss any new videos as soon as they're released. Thanks so much for watching. I hope you found this helpful, and I'll see you next week.